How does the insurance process work? Some of us would believe that going to an insurance conference on a soggy Tuesday night in Boston is the definition of boredom. And while we might be correct, the history of the sector shows that it isn't as dull as it might first appear. Insurance has a rich history that includes everything from swashbuckling pirates to a fierce fire that destroyed the largest metropolis on Earth. But how exactly do those gray suits who sell insurance make money, and how exactly does one of the most intricate financial models actually operate? If these inquiries pique your interest, be sure to watch today's Could Be Anything channel. How does the insurance process work? Insurance is a type of financial instrument that aids in risk distribution. An individual is able to go about their personal or professional life without toppling under the weight of financial disaster by taking a risk from them and sharing that risk with a community. Let's take a brief look at two individuals. AFA and Will are the names of the two. "If I lose my cell phone, you'll have to get me a new one," AFA tells Will, offering to give him $10 in exchange. If Will concurs, then that alone constitutes insurance. Because they assess the risk and determine if it is profitable to take the chance, insurance businesses are profitable. Will predicts that AFA won't likely misplace his phone and will instead get $10. Will have $1,000 if he can find 100 additional people who are prepared to pay him $10 each to cover their phone costs. Will still has $900 in the event that one of those 100 persons misplaces their phone, and Will pays $100 in compensation. Since the ancient Chinese and Babylonians diversified their transportation risks, this insurance concept has been around. But modern insurance didn't really take off until the 17th century in London. The concept of modern insurance was developed while merchant marine men and dealers frequently congregated in coffee houses in the financial sector of London. Here is how one of these coffee shops served as the incubator for Lloyd's of London, the hub of global insurance. You have the client first. Let's say the client owns a ship that he is concerned will be destroyed by bad weather or stolen by pirates off the coast. The customer goes to an insurance broker. The broker inspects the ship, or procures an inspection of the ship, and determines the ship's entire value. After that, the broker evaluates the risk. He inquires about the client's destination and the type of cargo he will be transporting. He creates an insurance policy using all of this data and presents it to the underwriter, the third link in the chain. The underwriter might not cover some risks in exchange for a lower premium. And for a few extra dollars, he would throw in a few extra risks. The lead underwriter, like Will typically take on the majority of the risk and be the first to put his name on the policy paper, even if there are typically many underwriters approached. As he signs his name beneath the risk on the insurance policy, he is referred to as the underwriter. When it comes to accepting the insurance, the lead underwriter is the key person who will consent to any claims made under the policy. The insurance premium must first be paid to the broker, who will keep about 10% and give the remaining funds to the underwriter. Once the conditions of the policy are agreed to, it is made legal, the client is satisfied, and the ship departs. What would transpire, however, if pirates infiltrated the ship, took the cargo, and set it afire at sea? The client will communicate with the insurance broker, if he is still alive. Otherwise, a representative of the client and the broker will meet with the lead underwriter to deliver the bad news. The broker then negotiates the best claim settlement for the client or his or her representatives with the remaining underwriters. There may be as many as 20 on a large policy. Without taking a cut, the underwriters give the money to the broker, who then gives it to the client. By acting with gentlemanly honor and the promise of future business, the broker will assist in negotiating the best claims for his clients after the premium has been paid. Now, the underwriter's situation might not be entirely negative. He might have reinsured the coverage if he were prudent and not greedy. The underwriter assumes the role of the client due to reinsurance. While keeping a portion of the premium, the underwriter transfers ownership of the policy to another underwriter or group of underwriters. Not yet clear? Consider AFA and his phone insurance in the past. Will would keep $1 for each of his 100 clients if he resold his $10 phone coverage for $9 as opposed to the $10 he originally received, giving him $100 risk-free. In a similar vein, a large portion of the insurance that passes through Lloyd's of London today is reinsured outside the structure to smaller insurance firms all over the world. As a result, what begins as a straightforward contract between the client and the broker, or AFA and will, spreads throughout a corporate community where each participant stands to gain from the premium or share in any losses. The way insurance operates is by dispersing risk among populations. In this manner, maritime insurance was established. It was created out of the need for shipowners to continue operating their businesses in the event that they lost everything while at sea. How about property insurance, though? The Great London Fire of 1666, however, completely destroyed the city where modern insurance was invented, and renowned architect Sir Christopher Wren made care to include an insurance office in his new plan when he undertook the Great London Reconstruction Project in 1667. Today, the majority of homeowners have a property insurance coverage in place. Medical, life, travel, auto, and dental insurance are other frequent forms of coverage. Even pet insurance has become a significant insurance industry. The business model has changed over time. The strong competition among insurance companies today benefits you, the customer, as policies are offered at the most affordable price. In order to build a financial pool, businesses now underwrite as many policies as they can. They invest the premium collected from thousands of insurance in another financial product. Therefore, it is possible for the insurance underwriter to pay out more claims than they receive in policy premiums. However, they have all of those premiums invested in a high-interest investment plan, thus their source of income is distinct from the initial insurance product. In this case, insurance is a method of generating cash flow that may be put towards more profitable ventures. What do you think, then? Do you have coverage to guard against unforeseen events? Do insurance firms impose excessive fees? Is everything just a con? Comment below with your ideas to share with us. Also, be sure to check out our other videos in Could Be Anything channel. Thanks for watching, and, as always, don't forget to like, share, and subscribe. See you next time.